Welcome to the LiveSquawk podcast, where professional traders, investors, and market insiders get the unfiltered insights that matter most. Stay ahead of the curve with expert interviews and exclusive market commentary. Hello and welcome to the LiveSquawk earnings preview show in conjunction with Wall Street Horizon. This episode is pre-recorded and available from Wednesday morning ahead of the North American Open. To help navigate earnings season, I'm joined today by Christine Short, Head of Research, Global Corporate Events at Wall Street Horizon, which is a TMX company. Just a note, for those new to LiveSquawk, check out our website and trial the audio and written news feed. We are an audio news service there for the financial markets. For anyone who trades or invests in financial markets, we aggregate the news and bring it to you in a very concise and succinct way across our platform. And so give us a trial and see if it's something that you may find useful for your trading day. Before we continue, a quick disclaimer. The content provided on this channel is for informational and educational purposes only. Neither I nor LiveSquawk is a licensed financial advisor, and none of the information shared should be considered financial, investment, or trading advice. Please conduct your research, consider your financial objectives, and consult a qualified financial professional before making investment decisions. Investing and trading in financial markets carries risks, and past performance does not indicate future results. We are not responsible for any losses or gains resulting from following this channel's content. And with that, I'd like to bring in Christine. Hello, and thanks for joining us today.
Yeah, hey Harry, great to be here. Thanks so much for having me.
Awesome. I hope you're well.
You as well. Happy New Year.
Happy New Year. Can we still say that now?
Is it? I don't know. I haven't talked to you since last year, so
That's
I'm
true.
saying it to you. But you're right. We're getting. I think tomorrow might be the first 2 weeks. It's still okay.
Fair play. No, I'll take it. That's good. We want to really sort of head into the earnings and your expectations around what to expect from the numbers out of the corporate world this season. Hopefully we can try and squeeze in a mid-season update as well later in the period. But I just want to really get your thoughts, and also for anyone who wants to go and read up on what Christine's written, if you can go to the Wall Street Horizon and there's a piece up there that covers or previews this season's earnings. So please go ahead, and I'll put up all the links and where you can find that after the show. And just a reminder, this is pre-recorded on the Thursday. We will try and publish this tomorrow on the Friday morning ahead of Wednesday morning. I'm getting confused already. Ahead of bank earnings, because that's one of the things we will cover. The different start for earnings really for the banks at least this week. And with that, Christine, so let's have a look at the earnings season as a whole. What are your expectations and what are you looking for?
Yeah, it's actually supposed to be a pretty good season, especially when compared to Q3, which came in a little light. We had Q3 growth of 4.6%. Q4 is expected to come in with S&P 500 EPS growth of close to 12%. That would make it the highest growth rate in 3 years. Revenue growth of nearly 5% is expected. So we're getting back to kind of where we started the year. I think Q1 we had about 11, 12% growth. So we will see some of the same winning sectors that we've become accustomed to this year. So tech, communication services. Financial pops its head up though. They're actually expecting to be the leader of earnings growth for the quarter at about 39%. So, we're talking about the banks really kicking everything off tomorrow. So we'll see how they contribute to that. Lagging sectors still expect to see energy, industrials, and materials. But as we get into 2025, that is expected to turn around a little bit. And then just full quarter, because we're going to get the Q4 as well as the full year numbers. So calendar year 2024 is expected to close out just shy of 10%, which isn't too far off from where we came in the year. Usually you see that number, it vacillates, it comes down, it goes up. The beginning of the year, I think the expectation was for about 11.5% earnings growth for the year. So still a pretty strong, number considering where we came from. And then Going into 2025, that expectation for EPS growth jumps up to 15%, which is well above the 10-year average of 8% annual growth. So I think it's going to be a great, earnings season, and it's really the one that sets the tone for the rest of the year, right? Analysts are going to be looking at this earnings season. They're going to be looking very closely at beat rates. We know around 80% of the S&P 500 typically beats estimates, but it's not just the number of companies, but by how much they beat that analysts really want to see. The average this year or the last couple of years has been about 5 percentage point beat for companies. And so I think analysts are really going to be benchmarking on that to see that companies are still able to beat by about 5%. And that will likely filter into estimates for 2025. So if it's higher than that, if it's lower than that, we might see analysts come in and ratchet up or down based on how companies performed in 2024.
And is there a margin that you talk about the beat rate? Is there, when do you see warning signs? What would flash a warning sign if we don't get the sort of level of beats on average?
Yeah. I mean, I think you see investors certainly react in the stock market. We've seen more recently that companies that beat estimates don't get rewarded as much as historically they have, and a lot of the times it's because they're not beating by as much. And then companies that miss estimates are getting punished more than investors have typically punished companies that miss. And then on the analyst side, you see it really factor into forward estimates, both usually the back half of the next year. So second half of 2025, they usually go in and tinker a little bit. But if so, you'll see it in the stock market, how investors react to the stock. You might see the numbers look quite good, but versus the expectation, they're not as high, or, usually a penny beat doesn't do it. Investors are still somewhat disappointed. And so the stakes have just gotten higher because we've seen such impressive growth over the last 2 years. It's almost like investors are expecting more and more. The S&P grew over 20% in 2023 and 2024. It was the highest back-to-back growth years since the late 90s. The estimate for 2025 is a little more modest at 10% growth if you look at what Goldman Sachs and some of the other big banks are expecting. But still, investors have become, comfortable with companies just blowing expectations out of the water, because that's how companies set it up, right? They issue guidance that's quite a bit more conservative. Analysts follow it. And so you're expected to post, kind of blowout numbers every time because you're manipulating it a little bit. So when those don't come to fruition, as we've seen in past quarters, even in some quarters this year, we see investors really kind of react negatively to that.
Okay, fair enough. Just in terms of again, we've mentioned that we've got the Super 7 as always, and NVIDIA. Do you see a change in the guard in terms of the leading sectors or just the leading companies for 2025, or is it going to be more of the same? I know that we're looking for maybe a slightly better performance out of the likes of Microsoft, and so forth. But semiconductors were the flavor of the month or flavor of the year last year. Do you see more of the same in terms of that sector?
Yeah, it's interesting when we look at leaders of 2025 growth. We see tech is still kind of the top right there. They're expecting the highest year-over-year growth rate as far as earnings are concerned, and revenues, actually. So right now, analysts are expecting tech to lead with about 23% earnings growth and roughly 12.5% revenue growth. So yeah, they're still top of the docket. But then you look at some of these other sectors that were downtrodden in the last few years, such as industrials, materials. They're coming back into the fold. Maybe not for Q4, maybe not even the first half of 2025, but they're slowly improving. So we're going to see a broadening out of sectors. You mentioned the Magnificent Seven. Yeah, still expected to do quite well in 2025, but you will see improvement from some of the companies outside of those seven. So, the big concern in the last couple of years was this concentration, right? How can you have a concentration in just a handful of stocks and still have a healthy market? What if one of those goes down? And we didn't really experience that, right? The markets did great the last 2 years. However, if you look at just Magnificent Seven expectations for earnings in 2025, right now for growth of 21%, the other 493 companies are expecting about 13% growth. That's up from the 4% we saw in 2024. So
very healthy.
Very healthy, coming back up there, maybe not reaching, tech's still expected to lead, but again, we're going to see some support, some strength from some of these other sectors that have just been lagging the last couple of years. And I think that's something that investors are very comfortable with, because you want to see this broader sector rotation, more involvement from some of the other names. So like I said, industrials, materials, those are two names that look to start to make a comeback as we head into 2025.
Excellent. And just in terms of, if we start into the sectors now, and we'll focus a bit more on the banks for the next couple of minutes. So tomorrow, as opposed to Friday, as you mentioned at the top, we are looking for a number of banks to report, the likes of JP Morgan, Wells Fargo, Citi, Goldman Sachs, all set to bring numbers tomorrow, which, as you said, is unusual because we don't normally see that. So what can we look from the banks? We're expecting a strong quarter, strong end of year. Is it more looking back, or are we now looking forwards really for the banking sector as a whole? Is this just nice to hear, but we want to see what happens with rates and so forth for the banks to continue their performance?
Yeah, every quarter it's like, obviously the numbers are backwards looking, and it's the guidance you really want to focus on, because that's where you get an idea of what's going to happen in the future. And so,
Sure.
Yeah, we want to hear what are expectations for rates, what are expectations for, this new Trump presidency with the inauguration, coming just after a lot of these companies report. What about deal making? That was starting to come back at the end of the year, and there were, with the Fed starting to cut rates, there was this kind of optimism around initial public offerings and M&A, and now it will be cheaper to borrow once again. But we've seen the expectations for Fed rate cuts in 2025 dropping. So what does that mean for the investment banks? Well, like you said, hear from Goldman tomorrow and Morgan Stanley later in the week. Mortgage lending, that's another big one. Rates haven't come down very much here. In fact, they've vacillated. They came down a little, they went back up. So the cut we saw in September from the Fed didn't seem to help mortgage rates, and mortgage applications are down. That's a huge part of Wells Fargo's business. So it's going to be a mixed bag. I think there's still a lot of uncertainty out there because we're not quite sure about some of President-elect Trump's policies yet, but that will certainly be, a large part of the discussion when these companies report this week.
Yeah, undoubtedly. I'm glad you mentioned the little elephant in the room. The president-elect Donald Trump inauguration, for anyone who's unaware, is next Monday, which falls on the same day as Martin Luther King Day. So we have a U.S. bank holiday the same day we have the inauguration. And I want to. I mean, if you're happy to move on away from the banks and equities, per se, corporates, and onto the economics and the fiscal side of things, really, and this incoming administration. What are we? I mean, there's been a lot of scaremongering, I guess, brought on by President-elect Trump himself. But in terms of the reality and what it means for the U.S. economy and for the wider global economy, how do you see the first few months, I guess, or the first year of the second Trump reign, and the impact, more importantly, on what we're talking about, the corporate world?
Yeah, I think just judging from the commentary we saw in the Q3 earnings reports that came out in Q4, some of those fell before the election. So there was, some uncertainty about who the next president would be, and some that fell after. And so depending on, when you were reporting, you had a little more clarity in your commentary. The biggest issue, obviously, for many of these companies in the S&P 500 is going to be these proposed tariffs on goods made outside of the U.S., mainly China, having the highest potential tariffs. that impacts a lot of companies because a lot of goods are made outside of the U.S. It's going to impact the income that they make from those goods, and a lot of companies were coming up with their different plans, how they would approach that. The goal, of course, is to bring more manufacturing back here into the U.S., but many companies said we're just going to raise prices. The cost of moving our supply chain would be so great that it wouldn't be worth it to do so, and we'll have to pass those costs on to consumers, which is a huge problem for inflation, which we've finally wrangled and gotten to a place where it's coming down. I'm trying to think specifically companies such as Stanley Black & Decker, we had AutoZone, Columbia, even Walmart. And, you'd think Walmart has such a big box store. They have the ability to negotiate with suppliers.
Yeah.
They surely don't have to increase prices. But the CFO during the last quarter's call said tariffs could lead to increased prices in stores. It was a little too early to tell. And about 2/3 of their items are assembled in the U.S., but those remaining goods, would be subject to price increases that they'd likely pass down. They're always trying to diversify because we've been living under a tariff environment since the first Trump administration. But with the second round of tariffs, it'd be likely that goods, costs would go up even more.
Well, sorry, I was going to just jump in.
Yeah,
there was talk of if he were to impose universal tariff of say 10% or upwards, about widespread reshoring of say manufacturing production back to the US. I mean, is that a factor in all this as well in terms of, or is that a longer term underlying sort of thing that would have to develop over time? Really, obviously, you can't just reshore production at the flip of a hat. This is something that takes time and planning and the infrastructure to have the infrastructure
Absolutely.
in place. So
right, and
again,
I think a lot of companies. What's that?
Where does that? Yeah, where do you see that scenario potentially?
Yeah, I mean that was the commentary we heard from a lot of these names. It would take years and billions of dollars to reshore and to move, their supply chain efforts. I think of the companies I can recall, Steve Madden was one of the only ones that said they were going to try to diversify their supply chain away from China, where I think about 70% of their goods are made. But even that would take time. And in the meantime, they'd have to pass the increased costs on to consumers. But they were looking to cut Chinese production in half, move to Vietnam, Cambodia, Mexico. But that, consumers in the meantime should still increase or anticipate price increases because to pay for that move, not only, in the meantime, do they have to pay for tariffs, but then to pay for the move to other supply chains.
That's a very good point.
Right. They'd have to, someone's paying for that. And unfortunately, it's typically, put onto the consumer.
Yeah, very good point. Okay, so as I said, we have the president-elect coming in next week. Just a quick look at the more global corporate world. I've got a piece by Fitch here that says global corporate sales growth set to be tempered by slow European recovery. Obviously, Europe is one of the targets of tariffs from the president-elect, and do you see much of an external factor? I mean, a lot of the companies out of the US, as we know, are international conglomerates. They have bases all over the world. So on a wider scale, and we won't go into too much, but again, this Fitch report just suggests that sales growth to be tempered by slow European recovery. Do you see any external factors affecting the North American corporate world for, I guess Q4, we're looking back a little bit, but in terms of their projections into this year, or is it all on the Trump train and full steam ahead?
I mean, you bring up a great point, which is that, look, 50% of revenues from S&P 500 companies come from outside of the U.S. So we need a kind of good global, healthy global picture as well for many of these companies to continue to post the growth that they have the last 2 years. And if any piece of that, we've seen what happens when, there's slowing in China, slowdowns in Europe. That all rolls into, this is a global economy. And like you
Mm,
said, these are conglomerates. They operate everywhere. They rely on different partners in different countries. They rely on sales abroad. So yeah, if it's not full steam ahead, then like it has been for the most part post COVID, then we start to see these numbers drop a little. And yeah, certainly adding tariffs um, is not going to help the growth of these companies. Now,
mm.
will a lower corporate tax rate offset that? Maybe to some degree. But for the most part, companies have had a negative view of the tariffs, as have economists, banks. Even the National Retail Federation came out and said it was going to cost U.S. consumers almost $80 billion in annual spending power. So all kind of around the board, looking at what corporations have said, it's going to certainly have an impact.
Yeah, I mean, your intuition is much. Just we'll look back on the more to the Fed policy now as well, and how that may help to buoy on, or less so now, according to what we've seen. Last Friday's jobs numbers were very strong, and offered the Fed, I guess, an easy way out in terms of keeping policy on hold for the foreseeable future, for at least for this month. We've got a rate decision at the end of this month. Fed policy, we want to talk a bit more about monetary policy a little bit here. Do you have any views on Fed policy, and then maybe how that would affect, the corporate world? We touched upon the banking sector, but just the wider corporate world, I think, and in terms of monetary policy. What are your views on that?
Yeah, and it's crazy how it's changed in the last 6 months. Before the September, for the first rate cut we had in 4 years, the expectation was for a rate cut of every meeting after the September, I think, 18th meeting, and then for the first 6 meetings of 2025. After last week's jobs number, as you mentioned, being so strong, I think the probability, or if you look at the Fed funds futures, they don't give a 50%
No.
odds of a rate cut until June now. Even if last week the FOMC minutes came out from the December 18th meeting, and there was, I think, an expectation for 2 rate cuts. They had dropped it from 4, but then those jobs numbers just, kind of messed everything up once again, and now we're likely waiting until a June rate cut. And like I said, it means a lot, and we'll hear more from the banks tomorrow. It means a lot for deal making, IPOs, M&A, mortgages, borrowing for large ticket items, taking out money for small businesses. But on the other hand, like, certainly inflation has come down. We saw the producer price index numbers come out for December this morning. They rose about 0.2%. That was half of what the expectation was. We'll get CPI tomorrow. We'll get retail sales out on Thursday. So we have a lot of economic indicators to look at for the path of inflation, which, again, as I mentioned, if tariffs are imposed, that will be kind of, all up in the air once again. But certainly we see the markets don't like it when we have very strong numbers that delay Fed rate cuts. As you saw on Friday, it's one of those good news is bad news once again, because it became clear the labor market remains so strong here. And this is not an environment for regular, federal rate cuts.
Sure.
This is not the typical economy we would see that justifies having 6 rate cuts in a year. And so investors realize that markets really tanked on Friday because they realize that's going to impact, a lot of these companies.
Absolutely, and I think you're right. I mean, but just in terms of expectations, like you said, 6 months ago, we weren't, but the banks were calling for, like, say, 6 rate cuts into 2025. We're now looking at less than 2 over the course of the year. That can very quickly change again. If we get a couple of bad numbers, or the inflation starts to slow again. There is a lag, I think, between the PPI and CPI relationship.
Yes.
of was it 2 to 3 months? or maybe even a bit longer in terms of when you start to see those prices come through. But again, I've been reading up on stuff about it. It's inflation expectations that matter as much as anything else, because ahead of any kind of tariff imposition, we could see expectations start to rise, preeminently. So it's one of those sort of things. It's a moving feast, and I just think it's going to be an interesting first half of the year to see what prices do, whether prices become the story again, or is it still about the labour market and how strong that is that will, I guess, supersede any worries about inflation in the near term, at least. So it's going to be an interesting time for the US and North American markets. You've got a Canadian election coming up. You've got German elections coming up. So politically as well, there's a lot of moving pieces, I guess. Just to round off, today's call.
Yeah, absolutely. There's no lack of things to look at this year, and it certainly will be an interesting one. And as you point out, you really never know how the markets are going to react to any of this data, because like you said, you could have one good report followed by a bad report, and it's the markets can get quite volatile around this data. So we'll certainly be looking at it throughout 2025. We'll be paying attention to what policies are actually enacted. And as you point out, there's elections going on in all parts of the world. But for overall, the picture for earnings, the picture for U.S. equities is still quite bright into 2025. Maybe we don't get what we got the last 2 years, but certainly if we saw 10% growth in the S&P 500, we wouldn't be disappointed.
No, that's a good way to sort of finish this. And just to quickly, I've got a graphic up here that suggests that we get the peak of earnings season. When's that? That's February, third?
Yeah, towards the Q4 season's always a little more elongated just because of the couple of U.S. holidays we have here, but starts in February, and we've got 3 or 4 peak weeks where we see over 1,000 U.S. or 1,000 global equities report. This will change. Not everyone's confirmed yet, but I would say February is kind of the month to really be tuned in. And, week by week, we look at different sectors that tend to report by week. But yeah, starting the week of February 2nd, really through the end of February is when we'll see the bulk of reports.
Okay, and anyone who wants to find out a bit more and utilize your services, at wallstreethorizon.com is where they can find information about how to sign up and how to get subscribe to your services, I guess.
Yeah, and to the weekly newsletter. Sometimes we do twice weekly during the peak of earnings season, called the short list. And yeah, take a look at any of our data there.
Perfect. On that note, then, I'd like to finish and thank you for your time and your insights, as always, very invaluable. And I'd encourage anyone to go to Wall Street Horizon and just to take in what they can and see if it helps their investing and trading. Christine, thank you very much. We'd love to get you back on mid-season if we can, to sort of just do an update. And yes, well, thank you again, and thank you guys for listening. And we'll be back again, as I said, with Christine, hopefully mid-season. And we'll be back with our preview show tomorrow. Tomorrow, I say tomorrow. For those on Wednesday, we're back on Wednesday for a preview of US CPI and to review UK CPI and also preview data towards the end of the week, and the inauguration. But thank you again, Christine, and thank you guys for listening. Thanks for tuning into the Live Squawk podcast. Your edge in the market starts here. Subscribe now.